If you don't dollar cost average, you are absolutely insane. In this video, I'm going to explain why right now, dollar cost averaging is literally the only thing that you should be doing. I'm going to show you the specific stocks to dollar cost into, but first I want to show you some data on why dollar cost averaging is actually better than God. I'm looking at an article that I'm going to share with you. I'm going to link it in the description below as well. But basically, taking a look at this article right now, I don't know this guy, I'm not affiliated with him, I don't know anything about him, I'm just reading this article and I really liked it. So there's two different things that I want you to understand, okay? This is the scenarios, okay? The first scenario is, this is gonna be a scenario basically of dollar cost averaging versus being God and being perfect, okay? So you're picking the perfect dip, whatever. I'll show you in just a second. So first is dollar cost averaging, investing $100 every month for 40 years, okay? So for 40 years, you're investing $100. Consistently, doesn't matter, markets up or down. Now, number two, you guys can already probably tell that dollar cost averaging is gonna beat this perfect person, but let's just look why, and it's really, really interesting. So buy the dip. You can save $100 each month and only buy when the market is in a dip, right? When it's going down. So a dip here is defined as any time when the market is not at an all-time high, but the person makes this strategy even better. He says, basically, you will buy the dip and it's going to be like perfect. You're gonna pick the exact bottom. Like exactly when you buy, you will have exactly when the market is an absolute bottom before any two all-time highs, okay? So let's take a look at the chart and actually how this looks like, okay? So which strategy, by the way, which strategy would you think does better? I would think actually if you're a guy and you could perfectly pick the bottom, then that would be better. But actually, because markets go up long-term and they keep making new highs, and because you can't time the market, even if you can perfectly time it, you still can't beat the market if you just dollar cost average. So that is a short answer, but let's go over this really, really fast. I'm gonna skip most of this, but as you can see, all-time highs for the S&P 500 happen a lot, like literally a lot. I see so many green dots here. 1, 2, 3, 4, 5. Oh, I'm too lazy. There's like, I don't know, like 10 of them or something. Wait, what 10? Like 50 of them, right? There's been like 50 all-time highs in the past, how many years is this? This is from 1995 to 2018. So this is a little dated by 4 years, but again, not a big deal. Over 4 years, not that much has probably changed. And most importantly, the market really functions based on human psychology, and human psychology doesn't really change. You ever have that like stubborn uncle or something, or that stubborn brother or sister? Have they changed? Not too much, probably. I mean, sometimes people change, but they have to want to change. Anyways, so human psychology doesn't change, and that's why the markets don't typically change. That's why the markets are typically very predictable over a longer term period. Over the short term, you can't really time the market, and even over the longer term, it's not really good to time the market, but a consistent strategy is the way to go. And right now, because stocks are sold off so much, I mean, my portfolio is up a little bit today, which is good, and I have beaten the market. I am down less than the market is down. You can't really time the market. That's like, if you take out one thing from this video, it's that you can't time the market, and dollar cost averaging is the best way to do it. And I'm gonna show you some more statistics here. So all-time highs and dips for the S&P 500. So as you can see, there are definitely dips. These red dots are dips, but the green dots are far outnumbering the red dots. So there's actually far more good apples than bad apples in these examples for the S&P 500 going up, right? So these dips are points at which the buy the dip strategy would make a purchase. So essentially, if you could be perfect and then time the market, these red points are exactly when you would buy into the S&P 500, because you can see here, you wouldn't buy here because it makes a new bottom. So because it makes a new bottom, and you know this because you're perfect, you're like, hey, I'm just gonna wait until the very, very bottom. So then you would buy here. But still, you can see here how that's not the best strategy. Actually, you can't see here, but you're gonna see it in just a second. You're gonna see in the next, in one of the next charts. So yeah, obviously you saved a lot of money. That's why this green thing increases here, because versus $100 that you're investing in the market, dollar cost averaging, if you could pick the bottom perfectly, then it's gonna be every single month, hundreds, 200, 300, 400, 500, 600, right? It's gonna go on and on and on and on, and you're gonna collect lots of cash. And here you're like, oh, this is the bottom, I know because I'm perfect. And then you're gonna buy it right here at the very bottom, and you're gonna deploy a lot of cash, like a lot of cash. That's fine. But as you can see, it doesn't happen again until here. And then obviously we had many little new bottoms all the time in between these 2 points. So, but anyways, this is a really long stretch. This looks like 10 years or something. That's pretty crazy. But anyways, every time the strategy buys into the market, the red dot, the cash balance goes to zero. Yep, and invested amount moves towards, moves up accordingly. This is most obvious when we look at March 2009, when after nearly 9 years of cash savings, 10,600 is put into the market. So 100, that's 106 months, I guess. That's 106 months. So if we compare the portfolio value of buy the dip and dollar cost average, you will see that buy the dip strategy starts outperforming around March 2009. So there are obviously points where it does outperform, but not over the long term. But anyways, you can see here that over a shorter term period, buy the dip did outperform from, I guess, from 2009 on. So that's an interesting thing, right? And that's because a phenomenon of 2008 crash, I guess, really influenced buying the dip, and it did a little bit better than dollar cost averaging, but not over the long term. And I don't think that's gonna happen over the long term. And anyways, let's just go through more data. So if you want to understand why this one purchase is so important, let's consider how much each individual purchase for the DCA strategy grows to by the end of the time period. Each black bar in the chart below represents how much a $100 purchase grew to by December 2018. So final growth of each dollar cost average payment and buy the dip purchases. You can see the interesting chart right here. I love data so much. I have a data analytics degree along with economics, finance, and accounting. So I love looking at data, and I totally just trust data. My professor had a cup, "In God we trust, all others must bring data." And I was like, yeah, that's a good quote. Anyways, what I really want to look at, there's a lot of charts here. I just want to go down. I don't want to make this video too long. I want to go down to the point that I'm trying to get to, and then I'm going to show you which stocks to buy, because that's probably what you're interested in. So, all right. So dollar cost averaging outperformed. And had you just dollar cost average versus being completely perfect, you would turn, I guess, $0, you would invest $100 a month, right, into about almost $300,000, probably $290,000, okay? Whereas this would be about $230,000. So you actually outperformed from the 1974 all the way until 2018, right? That's when the study is. So that is a 25 plus 18, 43 years, okay? So over 43 years, or this is actually a 40-year study. So over 40 years, dollar cost averaging is better consistently versus being perfect. And by the way, like, nobody can be perfect. I can't time the market at all. Like, I'm just a guy, yeah, I have some experience, but I'm just a guy on the internet. I just cannot pick the bottom. Like, I don't think anyone can. If they tell you that they can, run to your nearest exit, okay? They're trying to, they're trying to fool you. Nobody knows, nobody knows. The market is a really random game in the short term, but in the long term, it goes from a voting machine to a, what's that quote from Warren Buffett? From a voting machine into an actual like predictor, right? Over the long term though, because over the long term, it's more mathematics, right? Whatever the company makes in terms of revenue, whatever hits the profits on the bottom line, and then the company is valued based on the cash that it brings in, the actual numbers. But many companies don't have those actual numbers, and short-term investors don't really know what's going to happen in the future. And that's why stocks move up and down. It's because different people have different opinions. Some people are like, well, for example, Tesla's going to rise a lot because of the humanoid robot. And other people are like, well, that's not going to come into fruition, and Tesla's going to have lots of competition, and they're not going to work out. So that's why some people buy and sell a stock, and that's why stocks are volatile. And the more people that have differing opinions, the more that stock is going to be volatile. So anyways, final growth of each dollar cost payment and by the dip. So yeah, it's a huge amount over the long term. It's like 20x. As you can see, if you put in $100, you get $2,000 out. So if you attempt to build up cash and buy at the next bottom, you will likely be worse off than if you had bought every month. Why? Because while you wait for the next dip, the market is likely to keep rising and leave you behind. So notice how he says likely here. So it is possible to buy the dip and try to time the market. Some people succeed. I have a lot of students in the Discord that are like, hey, I bought some put options and I ended up making 10x on my money. Great, that's good, but that's not a consistent strategy. That might happen once, but you can't consistently 10x your portfolio every single month. Otherwise, you'd just be a billionaire. And yeah, you wouldn't even be watching my videos. You'd just be a billionaire, right? So if you're looking for self-improvement and you actually want to become a better trader, become better financially, it's all a long-term game. It's really about dollar cost averaging, keeping a level mindset, not getting emotional about your trades, using options to hedge, and also using options to collect income, like covered calls and selling puts, which I have videos on, and you should also be subscribed to the channel and like these videos. It really helps me out, and I'm super grateful for that. But anyways, let's start out with this article, and then I want to show you guys some stocks that I would personally dollar cost into right now, and the stocks that are in my portfolio right now. And I'm always changing this up. I am trading the same stocks, but I'm changing it up. So anyways, missing the bottom by just 2 months led to underperforming dollar cost averaging 97% of the time. So what he means here is that if you just miss the bottom just 2 months, right? Because oftentimes, even in bear markets, and I had a question from a student, he was like, well, why don't you just short the market? If it keeps going down, we're in a bear market. The reason is because you can't time the market, and in bear markets, you get some of the biggest rallies. You literally see, for example, like back in 2008, 2009, when the market was falling 4 or 5% a day, right? It would also have some days where it would rise 4 or 5%. So those are huge rises, like 4 or 5% in a day. If you miss those, if you miss just 2 of those days, that's 10%. That's a really huge amount of money, right? It really adds up. So just missing a couple good days is really bad, and you can't really guarantee or time the market. So even if we're in a bear market, if you try to time it and you miss out on some of the big up days, oh, you're in a bad position, right? So, and I don't know about you, I don't have a proven method of timing the market. So that beats me. I don't know. If you have it, comment below if you know how to beat the market. But my recommendation is dollar cost average into high quality stocks. I'm a tech investor, so I love tech and consumer. So I'm going to show you some of the best tech stocks that you should invest in. And yeah, so anyways, this is just an article. I'm not affiliated with this guy. I'll leave it down in the link below if you want to read through it. But yeah, I don't know the guy, so don't go buy his stuff or whatever. I don't know what he sells. I have no idea if he's credible or not. But I do believe this because when I was in college and I was studying my finance textbooks that were going over how to beat the market, all the textbooks said that the markets are super efficient and there is no way to beat the market. There's only a good strategy of being in the market, which is index investing and dollar cost averaging. Those are the only 2 things I learned in my $300,000 degree from Drexel University in Philadelphia. I spent 5 years there. It was a good experience, but I can't say that I became a great investor by going to college. I became a great investor by having work experiences and then going through it the hard way of trial and error, and losing money my first 3 years, and then being a somewhat okay trader for 3 years. And then in the past 3 years, I've been trading for 9. 3 were bad, 3 were okay, and now 3 are phenomenal, and I became rich, but after 6 years of lots of work. So it looks like I'm an overnight success, but I'm far from it. I've been thinking about money and saving it and investing it for a long time. I know it's not as long as some other people, but I would say it's a relatively long time, 9 years, but that's not that long. I think anyone can do it, and that's why I have a Discord community, and that's why I teach students how to invest. And I just launched Henry's Inner Circle on how to actually save, reduce your taxes, make more money. Obviously, some of that is trading options, but a lot of it is just holistically having a good financial plan and being really good at personal finance. And just, yeah, all those links will be in the description. I launched Henry's Inner Circle just for this month because it's my birthday month. On October 31st, it closes, and the first month is going to be $97. And then after that, we were gonna close it off. And then if we introduce it, we're gonna have to double the price. So really important that you check out Henry's Inner Circle. Just take a look. I think it's gonna be really good and really awesome. And it's a good networking opportunity. There's 6 meetings a month. So 4 meetings and then 1 happy hour and then 1 agenda day where we just talk about something like reducing your taxes, going abroad, investing better, saving more, credit card points, stuff like that. Just anything around personal finance, because being a multimillionaire, it was a lot of hard work, and I spent a lot of money to acquire this knowledge and skill set, and I want to give it to other people for a very affordable price of dinner, basically. Cost of 2 for dinner for a whole month. So not that much, not that expensive. But all right, so let's go over some of the positions that I would dollar cost average into. So let me take out this and let me go to today's return. So I would really look at the tech stocks because technology is the future. We're going to keep advancing software programming, artificial intelligence. All of these are growth trends. And although some of these stocks are a little bit volatile, I would still recommend dollar cost averaging. For you folks that are watching me for options, options are fantastic, but you don't have to do option trading to get rich. You could just dollar cost average into really good stocks and hold them for a really long time. And I can't use the word guarantee, but I pretty much guarantee, right? As close as possible to guarantee in life, because nothing is guaranteed in life, but as close as it gets to guarantee, you're guaranteed to get wealthy over time. You're guaranteed to compound your net worth and your wealth, and that's just how investing works. $1 is going to grow as long as you put it into a decent company, and as long as that company doesn't go through some really hard times or something really bad happens, it's going to do just fine. And my example of that is, I don't have Starbucks here, but I always tell people who don't know anything about the stock market's risky, etc. I'm like, sure, but do you like coffee? They're like, yeah, I like coffee. I'm like, does your wife like coffee? He's like, yeah, my wife drinks coffee. I'm like, do you guys go to Starbucks? They're like, yeah, sometimes we go to Starbucks. I'm like, well, guess what? If you buy Starbucks stock, you think coffee's gonna go anywhere? Starbucks is expanding across the whole world. People love coffee. Starbucks has a great brand, a good experience for the most part, good coffee for the most part. I know some people are like, I make better coffee at home, 20-cent iced coffee at home, right? But still, Starbucks has a good brand, and they're gonna keep growing, and coffee's kind of addicting. I don't drink a whole lot of coffee, but it's addicting. I know it's kind of like a drug, right? Caffeine. But anyways, if you invest in Starbucks and you dollar cost average into Starbucks, good stock, number one. Number two, NVIDIA. NVIDIA just has a lot going on for it. A lot of companies will depend on NVIDIA, especially in the self-driving space and electric vehicle space. So NVIDIA is going to keep doing really well, and I'm a big fan of NVIDIA. The next stock that I would say is really good is Apple. So everyone has Apple phones for the most part. I know some people have a Samsung phone, and I used to. Now I have Apple. Apple has a great brand. Apple keeps introducing new phones every September. And to be cool, people just have to buy the iPhone, the latest iPhone, right? Even though they're not innovating as much, and there's some things that I don't like about Apple, like they're not really innovating as fast as they used to. It has slowed down and tapered off, and they're getting diminishing returns, releasing the 14th iPhone. But still, the stock is pretty stable, and recently it has gone down a lot. In fact, more than I thought it would. It was like, thought it'd be like $150 stock, and now it's at $138 per share. So I decided to invest about 4.5% of my wealth into Apple. And I am down a little bit, about 9%. I have 400 shares. My average cost is 152.5. I do trade options, as you can see. I'm down at the moment, but that's because I just rolled this covered call down. I had a 155 covered call, which made, I think it was like $3,000. I can look at my history here, just so you guys know. I don't BS anything. I'm just super, super transparent. I actually open up my history and just show it to you guys, because I've been doing this for a while, and I don't like to lie about things, because then I get caught up, and that's just not the way I do things. I like to be super transparent and honest, because you're gonna get caught if you start lying or whatever. I just don't roll that way. I don't roll that way, okay? Oh, I got a dividend from Apple, cool. Where was it? So I sold a 155. Where are you at? 155, 155. I did a lot of call credit spreads, as you guys can see, but I think it might be this one, 150. So as you can see, I bought for $1, and then I sold new ones. So I must have closed this out for $1, meaning whatever I previously sold it for, I made 100%. Whatever I sold it for, I probably sold it for a couple grand. Then I bought it back for $1, and I sold new covered call for another 1,500 bucks. So I just keep 1,500. Looks like I sold for 520 before. Oh, so I made 520 there. I made 520 bucks. Anyways, what I do is I keep selling covered calls, and most of the time I just win, right? Especially with Apple, because Apple's going down. Unfortunately, I'm down on the stock, but every time I sell covered calls, they're out of the money, and I'll just keep like selling new covered calls. I'll buy back the previous one for like $1, so I'll sell it for like $2, then I'll buy it back for like $1, right? So I made $1.99, and I'll just keep doing that over and over and over again every month. I trade like monthly now. I do like weekly option trading, and I do that a lot as well. As you can see, I have some positions expiring this week. Some of them are down, which kind of sucks because the market's down, but still I'm outperforming the market. So that's really all I can ask for. Can't really ask to make money when everyone else is down. Anyways, let's go through so many options. Okay, so other stock I would have is Amazon. Obviously, e-commerce giant Jeff Bezos, one of the richest men in the world. Elon Musk is richer than him. Haha, Jeff Bezos. But yeah, so Amazon's good. American Airlines, I like airlines a lot because, well, people want to travel and people will travel more and more. American Airlines has a good brand and it's a really cheap stock, so it's very small account friendly. So I'm a big fan of trading this in my community and my Discord just because it's affordable for most people. And there's a lot of money to be made on American Airlines because it's pretty stable. So selling put options has done really, really well. Google, I love Google. I think it's just way too cheap, under $100. Are you serious? Google has a price to earnings of like 17 or 16, below the S&P 500 for a tech stock. Makes no sense to me. I love Google and I love YouTube, and you're on YouTube right now. So yeah, again, smash that like button, YouTube, let's go, YouTube. But Google owns YouTube, so that's why I like Google stock. So anyways, I like NIO long term. I want to be invested in China a little bit, and I like electric vehicles a lot. I've been a big fan of the stock, and I bought the stock at $4 per share and $19 per share. And yes, I bought it for like $40 per share, and I sold it at $30 per share. And then I got back into the stock around, I don't know, $16, $17 per share. Let's just click into my NEO shares. 16, 17, 17.42. So I got some shares at 17.42, and I've been selling covered calls. But because today is Monday, my covered calls have expired. Let's take a look at my covered calls. Or no, I just got put on 9:30. So I got put on Friday. But I'll be doing covered calls. As you can see, I made some money here on the covered call, $55. So I like selling puts and covered calls a lot on NEO. Like my very favorite strategy is selling puts and covered calls on NEO. Anyways, I would also dollar cost into Shopify, SPY. I like Oatly. It's a small cap stock. It's very small. It's been underperforming. But hey, every small cap stock has been underperforming. And I know lots of YouTubers who have recommended way worse stocks. And this is a small part of my portfolio. It's a risky bet. It's something that I'm going to just hold for a very, very long time and see what happens. Because, by the way, Starbucks uses Oatly. They have a relationship with Oatly. Everywhere I go here, and I'm in Prague right now, I travel a lot, which is something I plan to talk about in Henry's Inner Circle. I pay way less taxes than most Americans, and I just travel anywhere I want, anytime I want. And it's because of option trading, but other online businesses that I own. So I want to teach you that in Henry's Inner Circle. But anyways, everywhere I go, they use Oatly, like everywhere in the world. Like, yeah, I thought Oatly was like an American thing, but I'm in Prague, and the local, so I go to a local cafe and sometimes I buy like a chai latte, and he uses Oatly. And I asked him, I'm like, are you buying Oatly from like Oatly, or are you just buying it like not wholesale versus retail? He's like, I buy it retail at the store. I'm like, okay, Oatly's making a lot of money on this guy because Oatly's expensive. It's like, I'm in Prague and they use crowns here, Czech crowns. And yeah, it's like 85 crown, which is like $4 for a little thing of Oatly. Like, they're making bank. I expect the stock to go up. Other stocks that I would own are Disney, Microsoft. I don't know about Meta. I like Meta. I have sold a put option on Meta. I want some Meta, but I wouldn't go too much into Meta because the Facebook platform isn't being used by the younger, the Zoomers or whatever. Yeah, the young people. I don't know. There's Boomers, there's Zoomers, there's Gen Z, there's Gen Y. I don't know. I don't know that stuff. I just don't care, actually. I don't know. But anyways, the older folks are using Facebook, but the younger crowd is not. They're going to TikTok and on YouTube, right here on YouTube. So Meta is losing a lot of people, and Instagram also is changing itself to look like TikTok. And people are like, what are you doing, Instagram? Like, we're on Instagram because we like photography, we like pictures. We don't want Instagram to become TikTok. And they're also not going to be able to compete with TikTok because they're not as good as TikTok. Like, they're trying to do everything and they're doing nothing, basically. So they're really cheap. The stock is 11 price to earnings. It's 11, it's cheap. So I would say have some in your portfolio. Dollar cost a little bit, but don't overdo it. Obviously, Tesla, obviously. And I've been out of Tesla for a little bit because I've been scared to buy it at the like $300 price. Now it's at $252. Things are looking better, a lot better. So Tesla looks good. I like Chipotle. I like my burritos. Nike has fallen like 12% recently, so that's good. I follow this stock just to get an idea of how far down it goes, but I don't like Tattooed Chef. And let's see, Palantir I like. Adobe is becoming a lot cheaper, so I like that as dollar cost average. And that's it. I don't like the crypto stocks, but I follow them. But anyways, the best thing that you can dollar cost average into is SPY, and the best investment that you can make is in yourself. So go ahead, check out Henry's Inner Circle. I want to help you invest in yourself so you can learn about finances, personal finance, investing, saving money, traveling, going abroad, saving taxes, all kinds of stuff. And I'm super excited for that. So go ahead, check that out. Hope you enjoyed this video, and I will see you in the next one.